I'm 81 years old, and I need to tell you something that's going to make your stomach turn. I have $847,000 in my retirement accounts, $750,000, and I can't touch most of it. Not without the IRS taking so much that what's left isn't enough to live the life I worked 43 years to earn. You think you're being responsible? You think maxing out that 401k every year, deferring those taxes, building that big, beautiful number on your statement is the smart move? That's what they told me. That's what every financial advisor, every article, every retirement seminar said. Defer, defer, defer. You'll be in a lower tax bracket when you retire. They lied, or they were wrong, or the rules changed. It doesn't matter which. What matters is that I'm 81 years old, sitting on nearly $1 million I can't use without hemorrhaging 30–40% to taxes. And I'm living in a 900 square foot apartment eating chicken 3 times a week because I'm terrified to withdraw what's mine. My name is Donald. I'm 81 years old. And the retirement tax mistake I made 40 years ago is destroying the final chapter of my life, the chapter I worked my entire life to afford. And if you're making the same mistake right now, if you're putting every dollar into traditional 401ks and IRAs and thinking you're being smart, you're not. You're building a trap. And one day you'll wake up inside it and realize the door locked behind you decades ago. It started in 1981. I was 38 years old working as an engineer for a manufacturing company in Detroit. They'd just started offering a 401k plan. Brand new thing. Most people didn't understand it yet. The HR woman, her name was Diane, she stood at the front of the conference room with an overhead projector, and she explained it like she was offering us the secret to wealth. Every dollar you put in reduces your taxable income today, she said, and it grows tax-free until retirement. When you're 65, you'll be in a lower tax bracket, so you'll pay less when you take it out. It's literally free money. Free money. Those were her exact words. I remember, because I wrote them down. I was making $42,000 a year. Good money in 1981. My wife Janet and I had 2 kids, ages 6 and 9. We lived in a decent house in Warren, Michigan. We weren't rich, but we were comfortable. Solidly middle class. The American dream, right? Diane said I should contribute as much as I could afford. The company matched up to 6%. I did the math. If I contributed 10% of my salary, $4,200 a year, I'd save about $1,000 in taxes that year. And with the company match, I'd have $6,700 going into my retirement account. It seemed like magic. Like the government was giving me a 20% return just for being smart enough to defer my taxes. So I signed up, 10%, every paycheck. And for 43 years, I never questioned it. Let me tell you what happened in those 43 years, because this is the part they don't tell you when you're 38 and signing up and thinking you're being responsible. Every year my salary went up, I got promotions, I moved from engineer to senior engineer to engineering manager. By the time I was 50, I was making $98,000. By 60, I was making $142,000. By the time I retired at 65 in 2008, I was making $168,000. And every year, I increased my 401k contribution to match my raises. Why wouldn't I? The more I made, the more I saved on taxes, the bigger the immediate tax benefit. By my final decade of work, I was putting in the maximum allowed. $1,695 a year, plus catch-up contributions after age 50. The tax savings were enormous. I was saving almost $5,000 a year in taxes just by deferring. It felt like winning. Janet handled our personal finances, the day-to-day stuff, while I handled the retirement planning. I read articles. I adjusted our allocation every few years. I prided myself on being smart about it. I wasn't one of those guys who ignored his 401k and then panicked at 60. I was on top of it, responsible. By the time I retired in 2008, I had $1.2 million in my 401k. Every penny of it, pre-tax, traditional contributions, tax deferred. We had about $150,000 in savings outside of retirement accounts. We had a house worth maybe $240,000 paid off. On paper, we were millionaires. We'd made it. I was 65 years old, and I thought I could finally relax. The first year of retirement was everything I'd imagined. We traveled. We went to Italy, spent 3 weeks eating our way through Tuscany. We visited our daughter in Colorado, our son in North Carolina. We had the time and the money, and I felt For the first time in my adult life, like I could breathe. Then April came, time to do our taxes. I'd withdrawn $80,000 from the 401k that year to fund our lifestyle. Nothing crazy, about half of what I'd been making when I was working. I figured we'd be in a lower tax bracket. Just like Diane had promised back in 1981, we weren't. Between the $80,000 withdrawal, our Social Security income, and a small pension I had from the company, our total taxable income was $126,000. We were still in the 28% federal tax bracket, plus state taxes, plus the fact that my Social Security was now 85% taxable because of the 401k withdrawal. We owed $27,000 in taxes. I sat at the kitchen table with the completed tax return in front of me, and I felt like I couldn't breathe. I'd withdrawn $80,000 to live on. We were paying $27,000 in taxes on it. That's 34%. 1/3 of our withdrawal gone. This can't be right, I said to Janet. The accountant checked it twice, she said. She looked worried. But I'm retired. I'm supposed to be in a lower tax bracket. You're not, she said quietly, because we're still making too much. That's when I understood. The lower tax bracket in retirement? That only works if you actually have less income in retirement. But between Social Security, my pension, and the 401k withdrawals we needed to live on, we weren't in a lower bracket at all. We were in almost the same bracket I'd been in while working. Except now, I didn't have a salary coming in. Now, every dollar I took out to live on was destroying the principal. I started doing the math. Really doing it for the first time. $1.2 million in the 401k. Sounds like a lot. It is a lot. Except I didn't have $1.2 million. I had $1.2 million minus whatever the IRS was going to take when I withdrew it. If I was paying 34% in taxes every time I withdrew, I really had about $792,000 after taxes. $400,000 of my retirement savings belonged to the government. I'd spent 43 years thinking I was building wealth. I'd actually been building a tax bill, and it got worse. At age 70, the IRS requires you to take required minimum distributions, RMDs. They force you to withdraw a certain percentage of your retirement accounts every year, whether you need the money or not, because they want their tax money. They've waited long enough. I turned 70 in 2013. That first RMD, I had to withdraw $47,000. I didn't need it. We were living fine on less. But I had to take it anyway or face a 50% penalty on the amount I should have withdrawn. So I took it and paid $16,000 in taxes on money I didn't even need. And every year the RMD gets bigger because it's based on a percentage of your account balance, and the percentage increases as you age. Last year at 80, I had to withdraw $68,000. This year it'll be more. I'm being forced to withdraw money I don't need, paying taxes at rates I didn't expect, watching my retirement account drain faster than I planned. And the cruelest part, if I'd put even some of that money into Roth accounts back in 1981, accounts where you pay the tax up front and then it grows tax-free forever, I'd be fine now. I'd have access to hundreds of thousands of dollars that the IRS couldn't touch. But Roth IRAs didn't exist until 1997. And even then, I didn't convert because I didn't want to pay the taxes. I was still thinking about deferring, always deferring. I deferred myself into a corner. Janet died in 2016. Heart attack sudden. She was 72. And this is the part that's going to make you angry. When she died, I became a single filer, and the tax brackets for single filers are brutal compared to married filing jointly. The 28% bracket for single filers starts at $9,150. For married filing jointly, it started at $153,100. Suddenly, with the same RMD, the same income, the same life, I was paying even more in taxes just because my wife died. The year after Janet died, my total tax burden was 37% of my retirement withdrawals. 37%. For every dollar I took out to live on, 37 cents went to the government. I sat in the apartment I'd moved to after selling our house, smaller place, easier to maintain alone. And I did the math on what I could actually afford to spend. And I realized something that broke me. I had $847,000 left in retirement accounts, nearly $1 million. And I couldn't afford to travel anymore, couldn't afford to help my grandkids with college, couldn't afford to live anywhere that wasn't this 900 square foot apartment. Because every time I withdrew enough money to do something that cost real money, the tax bill destroyed me. I was asset rich and cash poor. And the assets I had were hostages to a tax system I hadn't understood until it was too late. The second question hit me one night when I was 76, sitting alone in my apartment eating reheated chicken for the third time that week. Who did I become by making this mistake? I became a man who was proud of being responsible, proud of maxing out my 401k every year, proud of having a big number on my retirement statement. I told my kids to do the same thing. I told my son, put as much as you can in that 401k. It's the smartest thing you can do. I told him that. I gave him the same advice that's destroying my retirement. I became a man who confused deferring problems with solving them. Every year I deferred those taxes. I told myself I was being smart. I never asked what I'd do when the bill came due. I never calculated what I'd really have access to after taxes. I just watched the number grow and felt successful. I became a man who trusted experts without understanding what they were actually saying. Diane from HR wasn't lying. I would be in a lower tax bracket if my income dropped significantly in retirement. But she never explained that Social Security and pensions and RMDs would keep my income high. She never explained that the tax brackets would change over 40 years. She never explained that losing your spouse cuts your favorable tax treatment in half. She gave me half the truth, and I built my entire retirement on it. I became a man who sacrificed flexibility for tax savings. Every dollar in that 401k came with strings attached. I can't access it without taxes and penalties before 5912. I'm forced to take it out on the government's schedule after 71-2. I can't give it to my grandkids without them paying taxes on it. I can't use it for emergencies without triggering a tax bomb. I traded control for the illusion of free money, and now I'm 81 years old with nearly $1 million, and I'm afraid to spend it. Last year, my granddaughter Emma called me. She's 24, working her first real job out of college, making $54,000 a year. She was so excited. She called to tell me she'd enrolled in her company's 401k and was putting in 15% of her salary. Pop, she said, I'm doing it right, just like you taught me. And I felt sick because she was doing exactly what I'd done, making exactly the same mistake, building exactly the same trap. Emma, I said, I need you to call HR tomorrow and change something. What do you mean? Split your contributions. Put some in traditional 401k, but put some in Roth 401k too. Pay the tax now while you're young and your bracket is low. But Pop, you always said to defer as much as possible. I was wrong, I said, and saying those words out loud, admitting it, felt like something breaking open. I was so wrong, Emma, and I don't want you to learn that lesson at 81 like I did. She was quiet for a moment. Are you okay? No, I said. I'm not. I have $847,000 in retirement money, and I can't afford to take you to dinner at a nice restaurant because the tax bill would kill me. Does that sound okay to you? She came to visit me 2 weeks later. Drove 6 hours from where she lives. We sat in my small apartment and I showed her everything. The tax returns, the RMD calculations, the projections of what I'd actually have access to versus what the account statement said. This is insane, she said. This is what I built, I said. She changed her contributions the next day. She called me to tell me, 50% traditional, 50% Roth. She'd pay more in taxes now, but 40 years from now, she'd have real flexibility, real control. I saved one person, my granddaughter. But how many other people are making the same mistake right now? The third question came to me 6 months ago. I was sitting in my accountant's office, going over my taxes for the previous year. Another year of watching money I needed get eaten by taxes I hadn't expected. Donald, my accountant said, his name is Mark. He's been doing my taxes for 15 years. Have you considered a qualified charitable distribution? A what? You can donate your RMD directly to charity. It counts toward your required withdrawal, but it's not taxable income. It would lower your tax bill significantly. I stared at him. Why didn't you tell me this 5 years ago? I asked. I did, he said. 3 years ago. You said you needed all your RMD to live on. And he was right. I vaguely remembered that conversation. I dismissed it because I thought I needed every penny, but the truth, I didn't. I was hoarding money out of fear, taking my RMD, paying huge taxes on it, and then letting most of it sit in a savings account because I was terrified to spend it. Terrified that if I spent too much now, I wouldn't have enough later. That's when the third question hit me. What am I willing to sacrifice to make these final years actually mean something? Because here's what I'd sacrificed. Not intentionally, not consciously. But it had happened anyway. I hadn't seen Italy since Janet died. We were supposed to go back, see more, do the thing where you rent a villa for a month and just exist in a beautiful place. We never did. She died. And I was too afraid of the tax bill to go alone. I hadn't helped my son when he lost his job in 2019. He needed $15,000 to keep his house while he looked for work. I had nearly $1 million, and I didn't help him because withdrawing an extra $15,000 would have meant a $6,000 tax bill, and I couldn't stomach it. He almost lost his house. My son almost lost his house while I sat on a pile of money I was afraid to touch. I hadn't been to my granddaughter's college graduation. It was across the country. Flight plus hotel plus rental car plus meals, maybe $2,500. To get that $2,500 after taxes, I'd have needed to withdraw almost $4,000. It felt like too much, so I sent a card and a check for $100, and I missed her graduation. She never said anything, but I know she noticed. I know she wondered why Pop didn't come. I sacrificed experiences I'll never get back because I was trying to preserve money I'm terrified to spend. And the cruelest irony? When I die, everything left in that 401k goes to my kids. And they'll pay taxes on it too. Every penny they inherit, they'll owe income tax on. I built this pile of money thinking I was leaving them a legacy. I'm actually leaving them a tax bill. 2 months ago, I started making different choices. I called Mark, my accountant. I said, I want to do the charitable distribution. And I want to know every possible strategy to reduce my tax bill legally. All of them. Don't assume I won't do it. Tell me everything. We spent 3 hours going through options I hadn't known existed. Qualified charitable distributions let me donate up to $100,000 a year from my IRA directly to charity. It satisfies my RMD, it's not taxable income, and it actually helps people. I chose 3 organizations. One that funds college scholarships for low-income kids. One that provides meals for elderly people living alone. One that does medical research for the disease that killed Janet. Last year, half my RMD went to those charities instead of taxes. I got to choose where the money went instead of handing it to the IRS by default Roth conversions. I'm converting $25,000 a year from my traditional IRA to Roth. Yes, I pay taxes on it now, but it gets it out of the RMD calculation. It reduces my future tax bills.